Welcome to the deep dive. Today, we're doing something a bit different. Not looking at the latest market news, but really digging into one specific document.
That's right. We're going back to 1985, looking at the shareholder letter from Markel Financial Holdings Limited.
And this isn't just any old letter. This is, well, you could almost call it the founding document for the philosophy of what eventually became Fairfax Financial Holdings.
It really is pivotal. It shows exactly how new leadership, specifically V. Prem Watsa, stepped in and basically laid down the law, the whole long-term framework. It's fascinating stuff for anyone interested in, how great companies start.
Absolutely. So our mission today is to unpack that moment. We've got the letter right here, and it spells out their commitment to value investing, protecting capital, and setting some, frankly, incredibly ambitious goals.
It's a blueprint, really. Let's get into it.
Okay, so the letter doesn't exactly start with sunshine and roses. It says 1985 was a very significant year. You can kind of read between the lines there, right?
Yeah.
Significant usually means challenging.
Oh, definitely. Significant often means we almost didn't make it. The company needed a lifeline. The insurance market was tough, and they needed capital. Badly.
Survival mode, basically.
Pretty much, yeah. It wasn't just about growth. It was about shoring things up, stabilizing.
So the fix came in September '85. Stephen Markel and V. Prem Watsa arranged this private placement. Let's break that down. They raised $9.1 million in total.
Which was a lot of money back then.
A huge amount.
Yeah.
How did they structure that deal? Because the structure seems, well, critical.
It absolutely was. It wasn't just common stock. They used 14% voting, convertible preferred stock, and they threw in warrants, too. The key word there is voting.
Ah, okay. So the new money came with strings attached.
Yeah.
Or rather, levers of control.
Exactly. This structure meant the investors weren't just passengers, they were taking the wheel. It fundamentally shifted the power dynamic.
And who are these new drivers? Where did the $9.1 million actually come from?
Well, the biggest chunk, $5 million, came from a group called the 62 Investment Company Limited. This was like a consortium. Think of prominent Canadian business figures, Confederation Life Insurance, and Watsa himself was in there.
Okay, so the main investor group?
Right. Then you had Markel Core US chipping in $2.6 million and another $1.5 million from private investors.
But the crucial part, as you said, is that the 62 investment company got voting control.
That's the kicker. Overnight, Markel Financial Holdings Limited becomes a Canadian-controlled company. It wasn't just a bailout. It was a takeover, albeit a friendly one.
And the board changed immediately to reflect that.
Yep. New faces came in: Robert Hartog, Jack Herbert, Jim Martin, and Prem Watsa himself. Milton Markel stayed on as honorary chairman, sort of symbolizing continuity, but let's be clear, the strategic direction was now firmly with Watsa's team.
Setting the stage for everything that followed.
Which brings us to the why, and this is maybe the most surprising part. They didn't just look at the assets.
No, it seems like they were investing in the people, almost despite the recent troubles. The letter explicitly says the main reason was Stephen Markel and the Markel family.
Yeah, it's quite remarkable. The new chairman says they were very impressed with the way the company had been run, even through those, hard times. They saw something beyond the immediate financial stress.
Integrity, it seems. They mentioned the chairman personally experienced the high integrity displayed by Steve and the Markel family during the deal negotiations. That's a strong statement.
Incredibly strong. And they didn't just praise them, they credited Stephen and Tony Markel's untiring efforts over the previous 2 tough years, suggesting the company may not have survived without them.
So it wasn't about kicking out the old guard. It was framed as a partnership.
Exactly, a true partnership. The letter talks about combining the Markel family's deep, essential insurance experience.
Which they definitely needed.
Absolutely. Combining that with the new group's investment background, that was the synergy they were aiming for. Insurance know-how meets investment strategy.
The engine, right there. And how did that translate into day-to-day management?
Well, they brought in a seasoned operational leader, Keith Ingo. He had over 20 years at Halifax Insurance. He became president of the Canadian Insurance Operations and EVP of the holding company.
So Ingo was the hands-on guy, running the actual insurance business.
Pretty much. His job was the day-to-day operations, making sure that side was solid. But the letter makes it clear. The big, long-term strategic decisions. Those were made jointly by Keith and Steve Markel, but obviously with the new controlling group guiding the overall direction, especially on the investment side.
Makes sense. Keep the insurance experts focused on insurance while the investment experts handle the capital.
And that capital allocation piece is where we see the philosophy really take shape. This is the core, isn't it?
It really is. They didn't try to reinvent the wheel. They were very clear. We're adopting the value approach laid out by Ben Graham.
And they specifically mention his famous disciple, Warren Buffett. I mean, they're literally naming their heroes, their influences.
It's like saying this is our playbook. No ambiguity.
None at all. And the playbook is simple, conceptually at least. Buy stocks of good, financially sound companies when they're cheap, below their long-term intrinsic value.
Sounds straightforward, but doing it requires patience. And maybe something else.
Yes. The magic ingredient, often unstated but crucial, insurance float. You absolutely have to understand this to get the model.
Explain that. Why is float so important here?
Well, an insurance company collects premiums up front, right? But it only pays out claims later, sometimes much later. That money it holds in the meantime, that's the float.
Okay, so it's like customer money they get to hold on to.
Exactly. And importantly, they often get to hold it at little or no cost. Sometimes, if underwriting is good, they even make a profit on holding it, an underwriting profit. So this float becomes a pool of very stable, very cheap, long-term capital.
Ah, I see. So the insurance business isn't just selling policies, it's generating the fuel for the investment engine.
Precisely. The value investing strategy needs patient capital. You need money that can sit for years waiting for the right price. The float is that patient capital. That's the genius of the Berkshire Hathaway model, and it's the model Watsa explicitly adopted here. Insurance and investments feeding each other.
Okay, got it.
Yeah.
So armed with this float, they adopt the Graham philosophy, but they also manage expectations immediately, don't they?
Oh, yeah. They tell shareholders straight up, we expect to make money over time, not in the next month or two. They acknowledge stocks can go down, even way below what they paid, in the short term.
Discipline and long-term focus.
And underpinning that is the absolute priority. First, protect your capital from long-term losses.
Right.
That comes before trying to make money. Risk management is job one.
Which leads them to list things they absolutely won't do.
Right. They explicitly state, we do not speculate with your money. And they list the forbidden fruits. No options, no commodities, no futures, no gold, no short-term trading stuff.
Why draw such a hard line? What's wrong with those instruments if used carefully?
Because speculation, especially using leverage or derivatives like options and futures, introduces risks that are totally disconnected from the underlying value of a business. You can be wiped out by short-term market swings even if your long-term view is right. It creates the potential for permanent capital loss.
So, by banning them, they're basically building guardrails, preventing themselves from chasing quick, risky profits.
Exactly. It enforces patience. It protects that precious float. It builds trust with shareholders that they won't gamble the house, even if it means missing out on some potential short-term gains. It's structural discipline.
Okay, philosophy established, no speculation, long-term view. Now, how do they tell shareholders they'll measure success? They seem pretty committed to transparency.
They do. They mention the 85 annual report is their first stab at more complete disclosure, which implies they plan to be open. And the core commitment is running the company for the long-term benefit of all shareholders.
But talk is cheap. What's the actual yardstick?
They're very specific. Performance will be judged on one key metric, after-tax return on common shareholders' equity. ROE after tax.
Why that metric specifically?
Right.
Why not, say, earnings growth or stock price?
Because after-tax ROE cuts through a lot of noise. It measures how effectively management is using the owner's capital, the equity, to generate actual profit after the government takes its share. It's about compounding the shareholder's stake directly, very owner-focused.
Okay, makes sense. And then they set the bar, well, incredibly high.
They really do. They point out that historically, the average Canadian company earned about 13% ROE, kind of the baseline expectation.
And their goal?
Their objective, stated right there, is to achieve a long-term return averaging 20% while keeping the company financially strong.
Wow. Okay, wait. 13% is average, 20% is. That's way up there. That's top-tier performance, consistently.
Yeah.
How on earth did they think they could promise that? That seems almost reckless.
Well, they acknowledged it was a very challenging objective long-term. But, and this is a really crucial bit of context they provide, they had an ace up their sleeve, at least initially.
Which was?
Tax loss carry-forwards. Remember those hard times the company went through? They generated significant losses.
Ah, so those losses could be used to offset future profits, reducing their tax bill.
Exactly. It's like a temporary tax shield. They actually say in the letter that because of these tax losses, hitting 20% after-tax ROE is unlikely to be onerous for the next few years.
So it was like having training wheels for their ambitious goal.
Kind of, yeah. It gave them breathing room. They could aim for that 20% target knowing taxes wouldn't bite as hard initially. But the real challenge, the one they were setting themselves up for, was maintaining anything close to that 20% after those tax benefits eventually ran out.
Which would require truly exceptional performance from both the insurance underwriting and the investing year after year.
Absolutely. It set a very high bar for sustained, long-term execution, powered by that float and disciplined investing. It told shareholders, we're aiming for the stars, and here's why we think we might just get there, at least initially. Hashtag outro.
So looking back at this 1985 letter, it's just packed with significance, isn't it? You've got the emergency capital, the focus on integrity, the explicit adoption of the Graham Buffett playbook.
Fueled by the insurance float. It really lays out the entire foundation. It's not just a change in management. It feels like the declaration of a new corporate identity.
And you can see exactly why people started calling Watsa the Canadian Warren Buffett. It
Yeah.
wasn't just a folksy nickname. He literally adopted the same core operating model.
Right. The discipline, the focus on float, the long-term value investing, it's all there right from the beginning. The parallels are undeniable because they were intentional.
It's amazing how clear they were. They said what they would do, buy good businesses cheap, and just as importantly, what they absolutely wouldn't do, speculate.
Which brings us to a final thought, maybe something for you, the listener, to chew on. They set this incredibly high bar, 20% ROE long-term, but their absolute first priority was protecting capital, avoiding permanent loss.
Right. So the final thought is,
Think about the psychological discipline required there. If your goal is 20%, but you've explicitly forbidden yourself from using many of the tools others might use to chase high-return speculation, leverage, derivatives, what does that say about the conviction needed? How much does that commitment to not doing certain things actually cost in terms of day-to-day temptation, and how crucial is resisting that temptation to maintaining long-term shareholder trust while still aiming for that very high target?
it's a tough balancing act.